Understanding promissory notes, a comprehensive overview. A promissory note is an essential financial instrument that serves as a written commitment from one party, the issuer or maker, to pay a specific sum of money to another party, the payee, at a future date or upon request. Acting as both a legal contract and a financial tool, promissory notes play a crucial role in various lending scenarios, from personal loans between family members to substantial corporate financing. Key characteristics of promissory notes. Promissory notes are unique in that they embody a commitment to repay a specific amount under defined terms. Here are the critical components commonly found in a promissory note. 1. Names and addresses, identification of the borrower and lender. 2. Maturity date, the date by which the loan must be repaid. 3. Principal amount, the total sum borrowed. 4. Interest rate, the cost of borrowing, which can be fixed or variable. 5. Payment schedule, specifies how and when payments will be made. 6. Late fees, conditions under which extra charges apply for overdue payments. 7. Default terms, provisions outlining what happens if the borrower fails to repay. 8. Governing law, the legal jurisdiction that will govern the note. The functionality of promissory notes. Promissory notes encapsulate a financial promise that can bridge the gap between informal IOUs and formal loan contracts. Unlike an IOU which merely acknowledges a debt, a promissory note includes explicit terms for repayment. The flexibility of these instruments enables individuals and businesses to obtain financing either from traditional banks or private entities, thereby democratizing lending. Generally, there are two parties involved. Promisor, maker, the entity promising to repay. Promisee, payee, the entity lending the money. Secured versus unsecured promissory notes. Promissory notes can come in two forms, secured and unsecured. Secured promissory notes are backed by collateral, such as real estate or vehicles. If the borrower defaults, the lender has the right to take possession of the collateral. Unsecured promissory notes do not involve collateral. In this case, if the borrower fails to make payments, the lender must utilize the standard debt collection process. Both types serve the purpose of facilitating loans while enabling the lender to gauge the associated risk. Types of promissory notes. Promissory notes serve various purposes, often tailored to the specific needs of different borrowers. Some common types include: 1. Student loan promissory notes. Students typically encounter these when they take out loans for their education. Depending on the lender, students may need to sign a master promissory note that covers multiple loans over time. 2. Mortgage promissory notes. When obtaining a mortgage, the signed promissory note represents the commitment to repay the borrowed funds used to purchase a home. It outlines important details such as payment amounts, due dates, and potential consequences of default. 3. Corporate promissory notes. Businesses often use promissory notes as a form of short-term financing or when cash flow issues arise. For example, a company might issue a promissory note to settle invoices while waiting for its customers to pay their receivables. 4. Investment promissory notes. These can be offered by companies seeking investors. However, these notes require careful scrutiny, as they can often be high risk, especially if associated with organizations lacking proper registration or stability. Promissory note repayment structures. The repayment of a promissory note can occur through various methods, including installment notes. The borrower makes scheduled payments until the debt is fully settled. Simple notes. A lump sum payment is due at a specific date, covering the principal and any interest. Open-ended notes allow the borrower to draw funds up to a limit and repay within a specified timeframe. Demand notes require repayment on the lender's demand, often without a specified repayment schedule. These structures offer borrowers flexibility but also pose risks if payments are not managed correctly. Investing in promissory notes. While promissory notes can be lucrative investments, they carry risks, particularly if they're issued by businesses struggling to fulfill their debts. Investors are wise to conduct comprehensive due diligence, verifying that the issuer is reputable and that the notes have been legally registered with appropriate regulatory bodies, such as the Securities and Exchange Commission, SEC. Important considerations for investors. 1. Ensure the seller is licensed to sell securities. 2. Verify the company is legitimate and capable of servicing its debt. 3. Check that the note is appropriately registered or legally exempt from registration. A brief look into the history of promissory notes. Promissory notes have evolved significantly over time. Historically, they have sometimes functioned as alternative currencies, exempt from government control. The establishment of various laws, including the 1930 Geneva Convention, has helped formalize the use and regulation of promissory notes across different jurisdictions, providing a framework that upholds their enforceability and function as secure obligations between parties. Conclusion. In summary, a promissory note is a crucial financial document facilitating loans between diverse parties. While their flexibility allows for various applications, from personal loans to corporate financing, borrowers and investors alike must approach them with caution. Proper understanding and scrutiny of the terms and conditions can help ensure the effective use of this valuable financial instrument, mitigating risks associated with default and mismanagement. Whether you are borrowing or lending, being knowledgeable about the implications of promissory notes can help streamline financial transactions and protect your interests.